This is the 10-Minute Contrarian Podcast. This is VP. We're a solutions-based podcast diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, nononsenseforex.com, and podcast players everywhere. Episode 173 is brought to us by Bybit. I think the most important things you're going to want in a crypto trading platform are liquidity, safety, and the ability to have somebody there should something go wrong or should you need help. Bybit is going to give you all three of those things. The added bonuses with Bybit is, one, it is not governed by the United States, and two, there are so many added promotions and benefits available to you should you choose to utilize them. They have the World Series of Trading right now, which is the largest contest in the world, and so many other promotions and airdrops and incentives. And those can be available to you too if you click the link down below in the show notes. That will take you to the blog that will give you all the information you need. And at the bottom of that blog is my affiliate link. Click that link, get signed up, and you too will understand that with Bybit, membership has its rewards. It is the 10-Minute Contrarian Podcast, and this past Tuesday, I and my co-host Rob Reinhold put out an episode of the Trading Psychology Podcast, which is my other podcast, if you didn't know. And to date, it received the lowest amount of downloads of any trading psychology podcast I've ever done. And this was not a surprise to me at all, because it was the first episode that was not about trading psychology. It was about investing psychology. And most people who listen to that podcast are primarily traders. Yeah, maybe they invest, maybe they don't. But you, if you didn't already listen to it, you don't need to go back and listen to it. The main objective of that episode was just to really get people off the fence in terms of whether they should invest or not. You absolutely should. We gave a plethora of reasons why that was the case. And just about everybody who listens to this podcast here has already crossed that bridge. However, for those of you who also enjoy that podcast, or for those of you who like to consume all of my material, one, there is a special place for you in heaven, just know. Congratulations. But you have also gotten a sneak preview of what we're going to talk about today. And we're going to dive much deeper into things here in episode 173. So if you are just joining us, the last few weeks we have been talking about investing, in particular investing the money you have already made after this whole storm passes, after our asymmetrical investments we are in now hopefully come to fruition. Now they won't all, but hopefully enough to where we actually for the first time have a real nest egg, have a real, large account that we don't necessarily need to draw from, and can use that nest egg to build a bigger and bigger nest egg. So we can either retire off of it, we can use it for whatever we want. And then once we're there, how do we optimize that? Because we certainly can. We talked back in the episode called Rule of 72, how every little percentage point we can add on to our yearly return makes a really, really big difference at the end of the day. So we should aim for getting as many of those little percentage points as possible without taking on unnecessary risk. Because, just like trading, losses damage that bottom line. And so we can also take the concepts we learned in trading, the whole win by not losing idea in particular, and carry that over into investing. Now, we also said in the very last episode last week how the majority of investors, whether it's individual or even firms, typically sit through the down times. And I'm talking about recessions. I'm talking about, years like 2022, which we saw, which was an overall down year. And they simply eat those losses, either because their firm is just too big and slow and unwieldy, and they simply lack agility to move in and out of these things. Because you don't have to move in and out of these things quickly, as we're about to find out. You can do them slowly and reasonably, but most firms don't even do that. And the most individual investors, they don't even know what they're doing to begin with, really. And what they certainly don't have in common with us, and I would argue a lot of firms don't really either, is they don't understand technical analysis anywhere near the level most of us do. Because I know most of you who listen to this podcast are also no-nonsense Forex traders, or at least you understand the concepts of what we talk about on the channel. And this is a gigantic advantage. I'll listen to investment podcasts, and they'll have a technical trader on there. And they always say, man, I really wish I knew what you knew. I really wish I understood this whole technical analysis thing. If I could combine that with what I know about investing, it would be such a game changer. And I'm over here like, I want to scream. I'm like, bro, just go to Baby Pips and learn. It's not hard. You guys know, technical analysis is not difficult at all once you learn it. It's pretty black and white. Can there be a lot of moving parts? Are there a lot of indicators out there? Sure, but at its core, as far as understanding a chart when you look at it, it's not hard. Yet these people just don't want to take the 4 to 7 days, however long it takes to go through Baby Pips thoroughly and take notes. But oh well, not our problem. We know technical analysis, and not only that, we can do it at a high level, which means, unless you choose to, we don't have to sit there and absorb the losses that most people sit there and absorb, because our charts will let us know when those downtimes are likely coming. Now, somebody out there might be saying, well, VP, that's probably not the best idea because we have been in such a long-term bull market. It's probably best just to go ahead and eat those losses because the gains are eventually coming soon. And that's why, a lot of people, if they just stay in the SPY, for example, which is the S&P 500 ETF, they continue to get, 10, 11, 12% gains over time. Correct. But we are trying to do things better. And in the last episode, I explained to you just how possible this is. And the way I have chosen to give myself an advantage in this market is by using my technical analysis, but not the exact way I do it in Forex. In Forex, I trade mainly the daily chart. I have incorporated some weekly into it as well, but it's still mainly daily. And it's with the same, very regimented system that I have taught the majority of you. Because as we all know in trading, especially in the Forex market, it has to be this way. You really do have to make sure you eliminate as many losses as possible. And we try to do that the best we can at No Nonsense Forex without making things overly complex. And as you all have noticed, when I talk about trading other markets, like metals, like indices, I typically make things a bit more simple. And I've even said, just because I have to because I'm American, that using something like the weekly chart makes a lot more sense here than the daily, because when you're using ETFs to trade, you're going to be eating a lot more fees the more often you have to sit there and enter and exit trades. But what I plan to do here, and what I have been doing in real time, and it's been working tremendously, is something different. I am really, really simplifying things here because not only am I able to, but it just makes a lot more sense to, because in this particular situation, with my actual nest egg and with these dividend stocks and vehicles we've been talking about lately, I am zooming out all the way to the monthly chart. And let me tell you, contrarians, this thing is an absolute cheat code. Unlike Forex, there are distinct advantages, in my opinion, that the monthly chart gives us for what we are trying to accomplish here. First of all, let me just say, as an American, with the tax rate we have, my tax on an investment drops from 37, 38%, maybe even 39%. I know Obama raised it and then it never came back down. Anyway, as far as short-term capital gains, drops all the way down to 15% if I hold something for a year or longer. And if you're following a technical system, then you want something that's going to, not always, but sometimes keep you in that, I guess you'd call it a trade, even though it's not, but keep you invested in that thing for possibly a year or longer, because that's just, we've spoken about this, just such a huge benefit. So many extra percentage points you can be adding on by doing that one thing. And you will never accomplish this with the daily chart or the weekly chart. Now, plus, let's not forget, the further back you zoom out and the higher time frame you use, the better your technicals work. This has always been the case. And I was a bit apprehensive if zooming this far out actually made a difference. And I'm telling you, from what I have seen and from what I've experienced, it works really, really well. I don't know if there's a way to compare if the daily works better than the monthly or not. I'm sure there is. But just on the naked eye test of what I've seen in the past and what I've seen in the present, it is quite accurate in terms of telling me when to best enter, when to best exit, and when to best simply just not invest in whatever the thing is I'm looking at. And it kind of does make sense if you think about it too. One of the big things that we have to concern ourselves with, even as daily chart traders, is news avoidance. Now, with something like, investing, even when it comes to the election and stuff like that, which is a definite stay away, it almost doesn't matter. You don't have to really worry about any type of news event. Because even if, let's say, you're invested in a particular stock and it has a really bad earnings report, you're going to take a little bit of drawdown at the time. But technically, if it's a bull market, for example, and that stock is still pretty healthy and has a lot of investors in it, it's probably still going to go up over time because that's just what the market is doing. So all of these things that your average investor and your average firm and your Wall Street people have to concern themselves with doesn't really have to concern you because you're simply too zoomed out for this to matter. And let's not forget the obvious benefit. You pretty much only have to come check in at the end of every month and see how everything's doing. You can pretty much not worry about anything at all up until that point. It's pretty darn nice. So if you take the inherent advantages we already have, the advantages we talked about in the last episode, and you add this into the equation, something we already know how to do that most people don't know how to do, I'm telling you, don't think those higher yearly returns on average are out of your reach. There's no reason why they should be. Now, let's put a plan into action. Now, all I'm doing here, this is very different than my Forex material. My Forex material is like, hey, this is exactly what you need to do. Follow this to the letter and get good at it. And then later, once you have already gotten good at it and sustained good results, then you can start to, monkey around with things if it makes sense for you to do so. This here, what I'm about to tell you, is very, very loose already. And you do not need to worry about following it to the letter. You do not have to worry about little exceptions that come up here and there and what do I do. You can probably figure those out on your own. And honestly, I don't see a whole lot of exceptions that can even really pop up here. So just take what I'm about to tell you as a very broad template, plug it in, and see how it's been working. And then use it in real time by paper trading and see how it works currently. And then you can customize this any way you want, any way that makes sense for you. All I can say is that especially when it comes to the money management side, that you stay disciplined. Just like we talk about with our asymmetrical investments. Write it down, whatever your take profit is going to be. Now, we're not going to be doing 2x, 3x gains with a lot of these investments we're in right now. But for something like crypto, for example, if you're going to take a 3x and take half of your money off the table, put it on a spreadsheet somewhere, write it down somewhere, and when price gets to that level, you need to execute. Very simple. This is something, again, most individual investors do not do. Most firms will do this, and that is why they get to be firms and your individual investor does not. Honestly, I think the majority of it just comes down to this one simple distinction. Your firm or your average fund has very rigid money management strategies, and everybody in that firm or in that fund is very aware of it. Anyways, now that I've said that, let's go ahead and proceed. So what you can do is go to a place like TradingView or Bar Chart or Market Watch, any of those free services. and enter in a stock or an ETF or anything you want, really, an index. Zoom out to the monthly time frame and just simply place a very basic confirmation indicator down below and just see how well it works. I think you're going to like what you see. Again, I don't understand why people act like this is so hard. It's really, especially indicators. But anyway, that's not our problem. That's their problem. Now, what other indicators am I going to add on? Am I going to add the best indicator of all time, the ATR? I'm actually not. You certainly can if you want some guidance on money management. But the only other indicator I am adding on here for this purpose is an exit indicator. That's it. I don't want a baseline because if you think about it, let's say we've had a big downturn in the market and now we want to catch the rebound. It may take us years to do that on the monthly chart if we're sitting there waiting for price to get above our baseline before we act. It just doesn't make sense to sit out for 3 years in the name of disciplined investing. And to the same token, that's the reason why I don't put a secondary confirmation indicator up, because secondary confirmation indicators are meant to slow you down. And with the monthly chart, we're already going really slow. Plus, let us not forget, the way at least I like to do things here, and the way a lot of you like to do things here, is if you end up entering something too soon and you take a loss. One, I've noticed the losses aren't really terrible here. Two, even though you're not going to be getting all of it for sure, at least getting a little bit of that nice dividend in the meantime is also going to buffer some of that loss. So, confirmation indicator, and you can tweak it to whatever settings you like that make the most sense. You can optimize this along the way, and you should. And then do the same with an exit indicator, and you're pretty much set, technically. Now the only thing left to figure out is your money management strategy. And again, I've been going very, very crude here. I may improve it over time, but so far I really haven't had to. So what I do is I do set a stop loss. You need that Armageddon stop loss, just so you don't lose everything. Now, even having a stop loss here is not important as doing it in Forex, because in Forex we can go negative to where stocks and indices and stuff like that can only go to zero. But I still like to have a stop loss there, just in case something crazy happens. You can set it really far back. How far back is completely up to you. Again, we're not setting hardcore rules here. You guys are smart enough and experienced enough to do this on your own. But just for disclosure's sake, I do have an emergency stop loss somewhere. Because under normal circumstances, my exit indicator is going to get me out at an appropriate time. The question always comes up, can you use your confirmation indicator as an exit indicator? You certainly can. It's typically not the most optimal strategy, but certain confirmation indicators, good confirmation indicators, can also do a good job at getting you out of trades. I have just found there are particular indicators that I really like for exits that do a better job for the system I run. Now, what I've also been doing is I'm just simply holding these instruments until my exit indicator tells me to get out. Now, why would I do such a thing? Well, part of it goes back to what we were talking about earlier on in the episode. Hopefully, best case scenario, I can hold on to whatever I'm investing in for 12 months or more to lower my tax rate. I'm not sure where it is in your part of the world. This is the reason why I never talked about taxes on my channel, because they're so different everywhere you go and they're always changing. But if you have a situation where it benefits you to hold for a year or more, then taking some off the table and letting the rest go actually makes less sense than it would if you were trading. It doesn't make no sense at all. It's still a good tactic. But for what we're doing here and the different set of rules we need to play by here, I'm just letting it ride until my exit tells me to get out. This way I have a better chance of holding for a year, and it also gives me the chance to eat more of those great dividends along the way with a full position on, as opposed to half a position. Now, for what it's worth, a volume indicator I think does not work here at all. I forgot to mention that earlier. You guys all know there's times where our volume indicator just does not allow us to trade for like months at a time on certain currency pairs. And if you extrapolate that out to the monthly chart, that's going to be a really long time. And I even said back in the indices video on my channel that the market is normally moving enough to where we won't have to worry about really long periods of absolute stagnation. Some periods of stagnation do happen, but not very long ones. That's just not how the market is. People are too absorbed into this market on a daily basis. Wall Street has to make their numbers. There's always a ton of liquidity coming into this market, even if sometimes it doesn't feel like there is. But anyway, that's, to me, a good rough template to start with. And you can customize this and optimize this however you see fit. If I was talking to people who have only started trading the no-nonsense Forex system, I probably wouldn't put it like this, but I am going to assume that the majority of people listening to this podcast already understand technical analysis, for one, and also understand my system of technical analysis pretty well. And if you don't, that's okay. The whole channel is right there for you. You can go to the beginner's video. It gives you the roadmap. It tells you what to do, and you can get started. But take the very basic structure I have given you and put it on a chart of Microsoft or the Dow Jones or crude oil or a renewable energy ETF, anything. I think you're really going to like what you see. Now, the advantages that we have and the ways we can optimize this even further, and I don't even mean technically, just naturally, don't have to end here. There are more ways to make sure that we are in the best position to get the absolute best of it as often as we possibly can. And we will be going over those in future episodes. Stay tuned for that. But I want to thank you again for joining me here on the 10-Minute Contrarian Podcast. And as always, understand that no matter what we do here, as eccentric and as different as it may seem to your average investor, to your average trader, that we are not crazy. We are just early.